Some housekeeping. If you have any questions, feel free to put them into the chat box on your Zoom bar, and we'll go ahead and answer those as we can. If there's any questions that seem to be a little bit in-depth and individualized, we'll just ask to take it offline, and we'll follow up with you. The webinar today is going to probably be about 45 minutes, maybe a little bit longer, depending on the content that we get into. And also at the end of the webinar tomorrow, you'll be receiving a survey. The purpose of that survey is twofold. One, to give us feedback, and then the second is to communicate with us that you'd be interested in having a year-end tax update appointment. So with that, we will continue on here. So a little bit about who we are. A lot of you are coming in from different avenues. Some of the folks on the phone are Leeds clients. Some of them are Vision Retirement clients. Some of them are people that are considering to do business with either of us. So all three organizations are a conglomerate underneath a conglomerate, Ridgewood Financial Advisors. We're a diversified financial services company, and we specialize in retirement planning and tax preparation and tax planning. A little bit about us. Kevin is our senior leader here, and Kevin started Leeds accounting a number of years back, right? 2 or 3 years ago. Yeah. And then Karen here is a professor, also a CPA, and an attorney.
Yes.
Yes. So you've gone through the ringer.
Yes.
With school. And then myself, I'm the founder of Vision Retirement and Ridgewood Financial Advisors. And together, like I said, we operate as a team, providing our clients with the best retirement and tax planning possible. So with that, we'll get started. I'm really excited about today. There was so much anxiety that people were having over what was going to happen with the tax law this year. And, we kept on saying sunset, sunset, and, the election came, and to be honest, coming right up into the election, I didn't think that we were going to, see that some of these tax laws would become quote unquote permanent. We'll give the disclaimer now, it's permanent until it's not, right?
Exactly. Exactly.
So, it's an interesting way that they sort of set things up here. In the old tax bill, it was going to sunset if nothing was done. And now only some of the things are going away. So it's not even a sunset anymore. It's like they're here for the next couple of years unless the new Congress, continues those items forward, which we'll talk about. I think this is the agenda for today. So we'll talk about individual tax changes. We'll talk about SALT, overtime, and other deductions, family benefits. We want to talk about retiree and senior planning, some of the estate planning, that is also here. The fiscal impact, tax cuts, don't come without a cost.
Right.
So it's going to be important that we realize that, there is a cost to this. And then guidance, like I said, for anybody that is looking to have a tax planning appointment, we'll have that opportunity on the survey that we send out. So let's go ahead and jump in. And Kevin, what happened here? So we came into the year, and all of a sudden we have a new tax bill.
We have a whole new tax bill, some of which is going to affect us for 25, even though we're in the middle of the year. And for us, we just finished up 24. So it's like a nonstop treadmill going on. So and like you just said, some of the things that it did made permanent what was not going to be available starting next year.
Yeah.
And that's a big piece. And we're going to show you in a couple of minutes the difference in withholding and how much, or not withholding, but with the tax rates and the tax schedules, and how much the change during Trump's first administration changed what was deductible or what was taxable.
Yep.
Yeah. The key takeaway is that we were all facing a tax cliff. Many of us were not aware of it if this 2017 Tax Cuts and Jobs Act expired. Mm-hmm. And so thankfully they did pass this law that keeps those expanded tax brackets and the lowered tax rates in place. So that's a good thing.
Yeah, and we're going to talk a little bit about, temporary, permanent, And I think one of the important things is that, this whole tax bill was based on, extending what, Kevin had alluded to was, Trump's in the Trump administration. They passed the Tax Cut and Jobs Act.
Tax, yeah.
And, that really lays out the foundation for a lot of the things that we're going to be talking about today. Because when the TCJA was passed back in 2017, in order not to bind future Congresses, that bill was set to sunset at the end of this year.
Yeah.
And, what that means is that if that did not, get extended, then we're reverting back to the things that were before TCJA. And I think some of us has forgotten about what the tax laws were in 2016.
Yeah.
And I think for most people, benefited from TCJA. And so if that would have gone away, we're talking about now, the pre-TCJA and all the, the middle columns here. So we had, higher corporate taxes. We had the individual tax brackets that we'll show in a minute. So we had cuts in that. The standard deduction. I mean, I think some people forgot what it was like to, how low it was and what it was like to itemize.
Right, exactly.
Yes.
Exactly.
And I think when TCJA was passed, one of the things that people focused in on, especially in New Jersey, was the salt tax, which we're going to talk about.
Yeah.
So,
Absolutely.
there was a lot of things that, were enacted back in 2017. And so here we are in 2025, and a lot of those things were made permanent. Oops. And one thing I do want to just say is, the estate tax too. The estate tax was something that we used to do as financial advisors was, a lot of work around helping people make sure that, they weren't subject to estate tax.
Right.
Where you brought up something really interesting, Karen, is that although New Jersey does not have an inheritance tax for Class A beneficiaries,
Right.
there are inheritance taxes still in New Jersey that people fall victim to.
Absolutely. And it comes up more frequently than you could possibly believe.
Yeah.
And so I think when we get to the estate tax section, we'll address that a little bit.
Yeah.
There's some planning to do with the estate that you don't think about.
Mhm.
It's the state piece.
Yeah,
Yeah.
Can
exactly.
be done.
Yeah.
Exactly.
So here we were in 2017, and for those of you on the webinar, you can see where your income is and what you were being taxed at in 2016 versus what you're going to be taxed at continuing on today. And again, this was the big part of the One Big Beautiful Bill, was making these tax brackets permanent. And again, we say permanent until
They're not.
So, and Kevin, let me just ask you, I mean, you've been practicing for a lot longer than I have. These tax brackets are really pretty favorable for most people, wouldn't you say?
Absolutely. These are the best that it's been in recent memory.
Yeah.
It's very reasonable compared to where we've been.
Right. So there still is, again, for people thinking that, tax rates, are going to stay this low, again, they're permanent till they're not. So especially for younger people and they're thinking about, do I do pre-tax or after tax? I mean, those are a lot of good conversations that are starting to spark now with
Absolutely.
some of these tax brackets.
As an example, 20 years ago or so, the highest rate was 50%.
Yeah.
Yeah. And now we're at 37.
Right.
So a substantial difference.
Absolutely. And I think, the ones that I typically focus in on here, and not to go back and forth, but if you look at this 22 and 24% tax bracket, this is pretty much, Bergen County to a degree. Obviously there's a lot higher, but, if you think about, the average person in Bergen County, you're, sort of in this, and Poughkeepsie, New York, you're in these tax brackets here between New York and New Jersey. And if you look, right away, most of it falls in the 28% and higher.
28 or 33.
Yeah.
So right there, it's a huge difference.
It's a huge difference. So, that's just interesting to note there. So we said that these are permanent now, until they're not, but that's definitely something that we want to keep in mind here. Let's talk about a standard deduction.
Yeah.
What is a standard deduction?
So a standard deduction is the deduction from your income that everyone can take. You don't have to itemize. It's actually instead of itemizing. So if your itemized deductions aren't higher than the standard deduction, you get the standard deduction. And it's actually, if back on the previous slide, they used to be much lower, around 12 or 14,000, I think. And now we're seeing joint filers getting a deduction of 31,500. It's automatic. You don't have to have a mortgage. You don't have to have, medical expenses or anything. And single filers, it went up to 15,750. So it's significant. And I think that's one way that this bill is helping kind of everyone. So it's not limited to helping itemized taxpayers.
Right.
It's going to help people who actually don't, who rent.
Yeah.
And have that mortgage or real estate tax that kind of would boost them up over the threshold. So yeah, the standard deduction plays a really big part in tax savings.
Yeah.
And yeah, people should be excited about that one.
Yeah.
And in the past, for the last couple of years, with the SALT and not being able to really deduct all of your state taxes, this is even more significant.
Exactly.
So just to be clear, then, if I make 100,000 and I'm married, I get to deduct 31,500. So the result is my taxable income, all things equal.
Yes, absolutely.
So that's how the
yes, it comes like right off the
Yep.
tip.
And Karen, you said something very interesting about renting, and there used to be a big incentive for people to want to own a house, right?
Right.
Because you could deduct your taxes and your mortgage interest, and now, and I always wonder, when I'm driving around and I see all these apartment complexes going up, right? You wonder if we were still incentivizing for people to own a home, how much of that construction would be there. Just a thought. I have no idea. I have no evidence.
Right.
And I know the younger generations prefer renting as opposed to buying a home, but you put all that together and I think about it, and this is just my own dorky mind. I'm like, yeah, people don't care to own a house anymore because there's no real tax.
Not as much tax incentive.
And, it gives you a different lifestyle of where you don't have to worry about the upkeep and everything else. And so, I always wonder about that, but the standard deduction does level the playing field.
It really does.
Homeowners and renters.
In New Jersey, I know a lot of our viewers are probably or are in New Jersey. New Jersey does give a credit rent that you pay.
Yeah.
It's not dollar for dollar. It's not even close to dollar for dollar, but it is, it is something. So
something better than nothing.
Something's better than nothing. Yeah.
Awesome.
And the other thing is, one of the conversations I have quite often is, should I pay off my mortgage?
Yes.
And with the standard deduction being like this, often says, yes, do it. It's not worth paying 7%.
Right. Yeah.
Exactly.
Okay, so we have this bonus deduction, and this was really born out of a campaign promise around no tax on Social Security.
Yes.
That didn't make the grade.
Right.
So tell us a little bit about what's happening here with the $6,000 extra for seniors, right? So there's already something extra.
Right. So so right now, this is an addition to the already existing extra bonus for anyone over 65, which is $2,000. So this is on top of that. It's not instead of. And this is going to be a $6,000 credit, and it phases out at $75,000 for single, taxpayers, and $150,000 for joint taxpayers. And I just want to take a second to talk about what that means. Phases out. So sometimes people think, oh, I make over 75,000. This doesn't apply to me. This actually applies to you until you reach, if you're single, 175,000. That's the cap. And if you are married or filing jointly, it phases out completely at, I think 250 is the number there, 250,000. But the important thing to know is that for every dollar over 75,000, if you're single, the deduction reduces by 6 cents. So it's a pretty slow drop in deduction. So as an example, if you, let's say, make 100,000 as a single taxpayer, so you're over that 75,000 cap by 25,000, You'll multiply that 25,000 by 6 cents, right? And that gives you 1,500. That reduces the 6,000 by $1,500, but you still get a $4,500 deduction. So I know the 75,000 and the 150 seems a little bit on the low side, but again, it's a slower drop off of 6 cents per dollar over.
Right.
Yeah.
And it's still nice because if I'm doing my math correctly, you get 31.5 as plus 2.
Plus 2 plus 6. Yeah. So
And there's no phase out on the 2, right?
that's
That's
standard.
That's
Yeah.
standard,
Mhm,
right?
That's standard.
So, that's really pretty good.
Yeah, you're
you know.
getting up to about 40,000,
Yeah,
of right.
Basically standard deduction.
Yeah.
Yeah, for your standard deduction.
Yeah,
So, that's gonna be helpful.
yeah.
You know, just as a historical thing, Social Security wasn't always taxable.
Mhm.
Right. Right.
Our friend Ronald Reagan decided, and all the seniors loved him, but he stuck it to them.
Yeah,
And made it 85% of your over a certain amount.
Yeah.
Right.
And this is just an attempt to bring.
yep, to bring,
Now, this is temporary, so we are gonna enjoy it while we have it,
Yep.
and hopefully it will be extended,
Yep.
but we don't know.
and that's one thing I don't think we commented on. We said temporary or permanent, but temporary is from 2025 through 2028 in most cases.
In most cases,
There are some things that go beyond that.
yes,
In most cases, we're talking about the 4 years, 25, 26, 27, and 28.
Right.
yes,
And then depending on what happens, with the next Congress is going to depend on whether or not they just vanish and, it's nobody's fault, right?
Right.
You can blame the other guy. And if there's some campaign promises, those are going to be brought back into politics. So this
exactly.
is
So
exactly where it stands.
to be continued, I think, yeah.
Yeah, but I still, just going back to the SALT deductions and everything else, I mean, getting up to that number for most seniors, I don't, it's rare that you're going to see a lot of people that are, not working anymore to have that level of deduction. So
Correct.
the standard
Right.
deduction plus the bonus.
Plus the bonus is probably gonna
It's all
encompass most, yeah.
All right, so this is the big thing here. What the heck is a SALT, Kevin? I don't know. Oh, I didn't know what a SALT was until 2016. Can you help me out here?
SALT is all taxes paid to a state or a local government.
Okay,
We always think it's the real estate taxes, which in New Jersey is one of the big ones, but it's also your New Jersey or New York income tax.
city tax,
City tax and
City
your, any personal
property
vehicle,
tax.
property tax,
It's all taxes that you pay to
Sales.
the state and sales tax. To
it's
state.
either sales or income. I don't think they give you both, but yeah,
Yeah,
Yeah.
but
yeah.
so it's not just real estate.
Okay. So yeah, I think that's a big thing. And when they capped it at 10,000, right?
Ooh,
I mean,
that hurt.
that hurt
Yeah.
because, a lot of people's property taxes are more than 10,000. So regardless of the other taxes that you're paying, that was the big one.
Yeah,
And that, got capped. So we do have some relief.
Mhm.
This was one of the biggest, debates that went on in Congress. They look at it that they want to, penalize, high tax states. And, they think and again, this is just my own concept. They think by, having a cap, they're going to lower the taxes. That's not really what happens
Right.
here.
right.
But so, we are getting that relief, at least up to the 40,000. And it's brought up some interesting conversations because, the standard deduction for under 65 for married, 31.5, right?
Mhm.
And now we got 40,000 in SALT. So are we going to see people going back to itemizing?
There's a good chance, in New Jersey and New York, California, some very high real estate taxes.
Mm-hmm.
And we add on top of that, the state and local taxes that you pay. It's very easy to get up to that $40,000 number.
Mm-hmm.
And so, yeah, I think along with mortgage interest and, the other things that you can itemize, I think we are going to see people going back to itemizing, getting over that 31,000
Mm-hmm.
number, and this becoming very relevant.
Right.
This is temporary, so it is going to phase out. And unlike the bonus credit for seniors, This has a threshold of 500,000. Once you reach that threshold, you still do get some benefits. It falls off much more quickly. It's 30 cents per dollar you make over 500,000. So once you hit 600,000, it reverts back to 10,000. Yeah, so if you're making like $601,000, you're gonna unfortunately lose out on the extra 30,000 bump
Right.
in this SALT deduction, but you'll be eligible for the 31,000 standard deduction.
So interesting planning opportunity here. Some people have deferred comps, and with the interest rate environment the way it is right now, there's always been this, what do I, is deferred comp right for me? Is this an area where somebody could, if they were at that, $499 mark and they had a deferred comp plan, could they use that deferred comp plan to help them with something here?
Yes.
Yeah, I think so. I think that's a good strategy to at least have a conversation about.
Okay.
Yeah, absolutely.
Another thought on this, a lot of our clients have second homes,
Right.
Mm-hmm.
and you can have real estate taxes on as many homes as you own. It isn't limited. Mortgage interest is on too, but this could be whatever. So if you have the house down the shore, you now get the
Now you can deduct that as.
That's great.
Yeah, it is really a good thing. We should mention that the mortgage interest capped at 750,000, right? So any mortgage, any loan you have over 750, you can't deduct the interest. That is something that was in the tax cut in 2017, and they have brought that forward. So that's, the one kind of not so great.
So don't take a mortgage.
Don't take a mortgage. Well, you can, but you can't deduct all of it.
That cap bounces around.
It does.
It was down to 500. It was not. It
Right.
was the whole bit. And if you do it in a period of time where it's 750 like now, it's grandfathered in.
Grandfathered. Right. That's a good point.
So this is one of my favorite ones, actually.
Okay.
I remember when I earned overtime, back in the day, and you would get these paychecks, and even though, you had overtime, it seemed like you were paying more in taxes than, from the withholding. So, I was talking to my daughter's boyfriend, and he was all excited. He's a union electrician.
Okay.
And, he's like, oh, I get my, I put in 10, 20 hours or whatever the numbers were. And he was all excited, and he got his paycheck and it was the same. So what's happening here? Why are they still taxing overtime?
Because nobody knows how to. Honest answer.
Yeah.
I'm sure
Really big questions about how to how to actually do this.
I'm sure the ADP and paychecks are having.
So I think the standard right now is that they're still taxing
it.
And it's going to be a credit, like you'll get the money back at the end of the year if this applies to you. And it's only on the 50%
premium. The IRS has one of the things in their website is kind of goes through this, and there's some new forms, and they're saying they're working on how that's going to have to get reported by the end of the year.
So this is going to be one of those things that if you are in an hourly wage and you are subject to overtime, that it's business as usual until you get your tax refund.
It seems like for now, that's kind of how it is, and that hopefully eventually there'll be a better system. But for right now, I don't think anybody really knows how to wrap their arms around it and deal with it.
And the same thing is with tips, right? And I guess people normally think about tips being cash, but in the world that we live in, that's not the case anymore.
Exactly.
Right. So a lot of people have their tips reported as income.
Yes.
So I'm assuming that's going to be the same as overtime. When you file your tax return, you're going to get back,
if it's being taxed, if it's right now being taxed, like they're withholding on it, you'll get it back at the end.
Okay. The tips for many years were not reported as cash. Then the ones that went through the credit cards were started to be reported.
Yeah.
And this has to be both of them. So I think there's going to be some time before.
Yeah. Just another situation where everybody has to adjust and kind of figure out
What's going on?
Paychex and
Yep.
ADP have to figure out what on
And
earth.
There was a lot of disappointed faces out there.
Yeah.
I can tell you because.
Yeah,
There's some qualifications for the tips. The owner of the company isn't gonna get
right.
and then there's some other
Okay.
pieces to this that reduce it, but basically the average person that gets most of their income from.
Is gonna be there.
Is gonna be
Right.
in
Yeah.
good shape, yeah.
Interesting one. All right, this is another interesting one. And so this reminded me back of, when we used to itemize. So basically buy a car, right? Between the next 4 years, the interest on that loan up to $100,000 is going to be deductible,
Yes.
right? What if I itemize?
So I think you take it even if you don't itemize.
Yeah.
I think this is one of
Yeah.
those ones that will drive everybody nuts.
There's going to be another one
Get
how to figure it out. Yeah.
Yeah, I don't think they figured it out totally, but my understanding is that you get this whether you itemize or not.
Yep.
And so, it's a good thing. It's American-made vehicles, right? So there's going to be some kind of information you're going to need
Yeah.
when you buy the car. It has to meet certain specifications. But yeah, it's a good thing.
Yeah. And I did read, and maybe you have some other information on this. If I buy a car in 2028 and I take out a 6-year note, for the length of the note, that interest is going to be deductible. Am I correct in that?
That's my understanding. Yeah,
understanding as
that's my
well.
understanding. Yeah.
Yeah. So that's good.
So
because
that's a good thing.
at least, this is one of those that, there's a period of time that it's eligible for, but it goes for the length of that note. So
Right.
that benefit is actually more
Right,
than.
exactly. And it might actually influence how you decide to finance,
Yeah,
right?
Absolutely. Lease or buy and.
Yeah, exactly.
Yeah, this is one of those, talking to people, once, and I saw an ad recently that, one of, I forget what auto manufacturer, but it says qualifies for the interest, it
Yeah.
has to be assembled in the United States.
Exactly.
So this is also eligible for foreign cars that are made in the United States. Yeah,
Right.
right. So, I think that was the key here is eligible vehicles.
US assembled.
US assembled vehicles, and then,
Yes.
there's a stronger, conversation now between leasing and.
Leasing and buying.
So
Yeah.
that's, an opportunity for people.
Because for a while it was, people would ask.
I used to get that question quite often, and most of the time I tell them, where do you get the best deal?
Mhm.
Right.
Because it didn't make much difference, but
Yep.
this is.
But now you have to really do some calculations. You need to see, spend some time thinking about how this affects
Yep.
your tax.
Yep. Awesome. QBI. This was made permanent. What is a QBI?
You want me to?
Jeff, you can take this one.
Okay, with the first Trump
Mhm.
changes, the tax rates for large corporations was reduced
To 21%, yeah.
significantly.
Mhm.
And some of the pushback was, what about the mom and pop store? So this is a way to give them some of that break of your net income in a business, whether it be a partnership, a sole proprietor, whether it's sole or LLC, and a
Mhm.
sub S corp. 20% of your income is not taxed by the IRS.
Yeah.
Oh,
So if you made $100,000, there's a 20% deduction or 20,000, and your taxable piece from your business is only $80,000.
oh,
So, which is.
It sort of levels, like you were saying. So the bigger corps got that 21%,
Yes,
and really nothing was helping the smaller business.
right, and that's what, and that's why it was put in to begin with. There are some limits on it,
Yeah.
Mhm.
which seem to have changed from different years. But,
Yeah.
Okay. So owning your own business, C Corp versus S Corp, the advantages are passing through.
This is one of them, because the C corp doesn't get the
Yeah.
benefit,
Yep. Okay.
because they got the
Well,
20,
they get the.
they got the
20%.
20.
Yeah.
They got a huge benefit.
Yeah.
Of course, the states don't recognize this. So.
Yeah.
Right, yes.
And again, I think that's important to say something, because I know we're going to have some more conversations about states, but this is all federal, and the states don't follow federal.
Right.
So there's a lot of nuances where, something may apply to the federal government, but it doesn't apply to the
Exactly.
state that you file in. So I think that's a great point out there.
And we live in the area of two states that don't like to follow anything.
Exactly.
So we're going to talk a little bit more about family benefits here. And I guess the government wants us to continue to have kids.
Yes.
So the tax credit was 2,000. They bumped it up to 2,200. And I guess, it's up to $200 is good for the next couple of years. So
Yeah, it's gonna expire in 2028 and then go back to 2000, but be inflation index. Still gonna be increasing hopefully over time.
So this is a good time maybe to talk the difference between a deduction and a credit. Because $2,200 doesn't sound like a lot, but it's a credit, not a deduction.
Right,
Right.
So
exactly.
what is the difference?
Yeah, so deductions reduce your taxable income.
Yeah.
Credits actually go right up against the tax, so it's dollar for dollar against the actual tax that you owe.
Got it. So if you offered me a deduction or a credit, I
You
want
want a credit. Yeah, you want a
Got it.
credit. That's better.
Right.
That's better. for
The tax law, the past one that we're updating, took away the deduction for children.
Right.
So it used to
Well, the
be
exemption.
the exemption, right? Because it was $4,000
$4,000.
off, and they all went away.
And
That-
depending on your tax bracket, 2,200 credit is better.
Mhm.
Certainly
Yeah.
for
So
local or lower income, it was
it's
a better
definitely
deal.
better,
So
right?
They really didn't lose much. It just was a different way.
It's just a different way of
Yeah.
applying it. Yeah.
Okay.
And this is, I believe, refundable.
Yes.
Right, so if your taxes are
Oh.
lower than 2,200, you're still getting,
Oh, so that
Still
would
gonna-
increase my refund.
yes, it's gonna
Right.
increase your refund.
Oh, that's
Put
awesome.
no money in, and
Yeah.
and
And
your
you have
income was zero,
zero.
et cetera, but you would still get this credit.
Yeah, so you'd still wind up with a refund.
Good reason to have some more kids.
Uh,
No.
But
No,
then we have the Trump accounts and
yes,
I guess there's, still some fuzziness around this as well. I mean, we have the
Yes.
basic framework. So what is a Trump account, Karen?
yeah, so these are kind of interesting. Any children born between January 1st, 2025 and December 31st, 2028 are going to be eligible for this. The federal government is going to deposit $1,000 into an account. It's going to be able to be used for education, job training, or their first home after 18 or after the age of 30, anything. But something really interesting about it is you don't have to just leave it at 1,000. Parents can contribute to this after tax, $5,000 a year. And I just came across something where I learned that employers of that 5,000 that parents can contribute, their employers can contribute 2,500 of it, and it's not considered taxable income. So that is like a really kind of good
Yeah.
thing and a really great way to start saving for your children. Remember, when you start your 401k, when you start working at like 20 or 21 or whatever age you start, you've lost that first 20 years,
Mhm.
right? So if you start saving when your child is a newborn, that money hopefully has 65 years to grow.
Yeah.
We're thinking really long-term
Mhm.
investment. So this is an area I think where there's a lot of benefits. Or at 30 they can use it for anything they want, maybe buy a house,
Right.
right? Or education at whatever that money grows to be.
Mhm.
But this is very different than a 529. This is tax deferred, not tax-free. So when you take the money out, my understanding and everything about this is a little fuzzy, but my understanding is that it is not taxed annually as it grows, but when you take it out, will be taxed.
Yep.
On the income,
On the income, yes,
Mhm.
on the income.
right? 'Cause it's like 529s in that your contributions are not deductible.
Right.
Right, because it's after tax,
It's after
right?
tax,
Yep.
right?
Yeah.
So are we going to get $1,000 hit to our tax return then for the contribution from the government?
No,
No,
Oh.
no. This is
Okay.
like this is something very new, very different. In addition to the child tax credit,
Yep.
this is separate and apart from our taxes, and there should be nothing on your tax return that charges you for this or in any changes your tax return.
Yeah. It's an interesting concept.
It is.
So the whole concept, and I've heard different reasons and different talkings about what it's for and why they did it and everything else. But one of the things, and again in my world is pretty cool, is that it's going to show families and children the power of investing.
Absolutely.
Right. So if you receive even just $1,000 and leave it there until you're 30. Rule 72, I love the rule 72, says that if you divide the rate of return, that's the number of years that the money doubles. So if I get a 7.2% rate of return every 10 years, my money doubles.
Right.
So at the age of 30, I put in 1,000, so it's going to be a nice way of showing people, the power of investing.
Yeah, absolutely.
Kind of concerns me on the back end as far as what they're trying to plant the seeds for in the future.
Yeah. Yeah, I think we all have suspicions about what that could be leading to, but we don't know anything yet.
It brings back the old Uniform Gift to Minors Act,
Mhm.
that you could put money away for your kids.
Yep.
Yes.
And
Before the
which
kiddie
was a
tax.
great idea, except many times that when the kid turned 18, it
Yeah.
was his money.
Right.
It became a red Corvette
Yeah.
on the driveway. So
Other than a college education. Right.
education. So they've kind of been phased out.
Yeah.
Yeah, it's an interesting idea, and I hope it's really beneficial. I think it can be very beneficial for
Yeah.
people.
So we talked a little bit about what, anything else you want to add to any of these family benefits that we see here. And just as a reminder, if you have a question, instead of raising hands, if you could just put those questions in the chat bar. And again, if there's something that we can get to pretty easily, we'll go ahead and answer some questions. Otherwise, when you do, you will be getting an email asking for a survey, seeing how we did here, and also seeing if you want to have a year-end tax planning consultation with any of us. So anyway, going back to what it means for us is, I think there's a lot of things different. Trump accounts are not going to be set up until 2026.
Right.
So if you had a baby in 2025, please don't fret. You still will be entitled to the Trump accounts. It's all good stuff there. So let's talk a little bit about senior planning now. So people over the age of 65, what's happening here now?
Well, we talked about the senior deduction a little earlier and the phase out. We mentioned that $6,000 is in addition to the $2,000 standard for being over 65, plus the, pretty high standard deduction that we have. And so, yeah, there's room, I think, for seniors to do a little planning and, go ahead.
Yeah, no, it's because sometimes planning is just a matter of moving things from one year to the other. And, it's the end of the year now. We've got a little over 2 months. So it's a time to look at some of that.
Yep. And so for retirees, there is, we always look at, how does the minimum distributions impact my income,
Yeah.
right? And, when we look at, cash flow modeling and everything else, people are just shocked, what those RMDs do to their income.
Right.
And then, of course, when we add income, bad things can happen, with other things that may or may not be directly related.
Exactly.
And so, Roth conversions have been a huge part of the old tax bill because everybody was anticipating, that higher tax brackets
Right.
going forward. So now that those are permanent, what are your thoughts about, Roth conversions?
Yeah, I mean, I still think if you're in the right tax bracket, it could absolutely work for you. And it's something to absolutely consider.
Mm-hmm.
Yeah, I mean, I don't know if you have anything to add on that, but since the tax, the bands are broad, the taxes are lower, why not convert it? This is permanent,
Yeah.
but
until it's
we
not.
don't know
Yeah.
what that means,
Yeah.
right? So
Yeah.
it just gave us more time, I think, to consider making that change.
Right, and maybe just do part of a distribution or something.
Mhm.
Right.
You know, I look at it too as how old people are.
Mhm.
And, you know, if they're closer to the end of, they're gonna wind up, it's gonna wind up in the estate in a couple of years, you look at it differently.
Right.
Kind of, do you like the kids or not?
Who do you want to pay the taxes?
Right.
Yeah.
Exactly.
So,
Lovely, Dad.
Yeah.
Lovely.
just in case. So, yeah. but
Yeah.
That's part of the whole process.
Right.
But
Yeah.
it is different now.
Yep.
Yeah.
Yes.
The big thing is that you look big picture,
Yeah.
right? So, you know, with anything, you want to see, you know, if you are converting and then that becomes taxable this year, what does that do to some of the thresholds where maybe it pushes you out of getting the itemized deduction or the salt
Mm.
tax? So there's just a lot of kind of holistic, big picture planning, I think, to do.
I think in a lot of cases, you almost have to do a tax return for somebody.
Yeah.
You know,
Yeah.
so
Yeah.
just project and look at estimates and stuff and see if you're close to
Mhm.
Exactly.
and what it'll do.
Yeah. And I'll be honest with you, you know, one of the things that really, you know, when we started working together, one of the things that really excited me was these planning opportunities for our clients, because, you know, as good as we are, you know, we always love to have people that are, you know, the focused in and the honed in experts. And I want to thank you guys because, you know, as we've continued to work together, you know, we've been able to do a lot of that work with our clients
Right.
to show them the benefits of, you know, do I do the Roth conversion? You know, what are the, you know, what kind of, you know, spend downs do we do? And, you know, RMD. So, you know, that is really the benefit of
Yeah.
planning and having both sides represented at the table. So,
Absolutely.
you know.
Absolutely.
So let's talk a little bit about IRMA. Because a lot of that we're talking about here, some people may or may not understand, and we can spend 2 hours
Yeah.
talking about this.
Yeah.
But maybe just quickly, you know, IRMA stands for income related monthly adjustment amount, right?
Mhm.
And that's the amount of money that we pay on our Part B and Part D premium.
Yes.
Part A is free. And I think, you know, some people approaching retirement are surprised to hear that we have to pay for Medicare.
Yeah.
And, you know, we really can pay for Medicare depending on how much money we make.
Yeah.
So can you talk a little bit about IRMA and some of the things? Because this is different than, you know, some of the phase outs that happen here.
Yeah.
This is a question I get now fairly often that I never got 2 or 3 years ago
Yeah.
because of
The income levels.
the
Yeah.
income levels.
Yep. So, you know, and again, this is, you know, then on the slide before when we talk about tax planning, you know, this is one of those other areas that we spend a lot of time in, you know, figuring out, you know, what is the best way to try to avoid some of these charges,
Yes.
because they can get pretty steep pretty
Yes.
quick. You know, as far as, you know, Social Security, I think it's kind of hard. Those, you know, you said that Ronald Reagan, you know, implemented tax on Social Security and nobody's changed the bracket since.
Right.
No,
You know, so maybe back in 1984, you know, it wasn't so bad, you know, because if you made, what is it, $38,000 for married, you
Right.
know, maybe that included a lot of people.
Right.
That hasn't been indexed.
No.
You know, there's really almost nothing people can do these days to avoid, you know, paying taxes on Social Security.
Right.
And, you know, that always, you know, intrigues me. But again, IRMA is another planning area.
Yeah.
And, you know, when income hits that tax return, bad things can happen.
That's right.
And that's, you know, the only thing that I like to remind people is that, you know, think about income. That's great. You have taxes, that's fine.
Right.
But then you have all these other things that happen. behind the
Exactly.
scenes.
and now this can affect when you want to take Social Security.
Mhm.
Yeah.
You never would think about it.
Right.
Yeah. So, again, one of those other planning opportunities. We'll take the remaining time, talk about some of the estate tax exemptions and things like that. I think the biggest thing here is that it's permanent. Prior to 2017, we were in like the $5 million.
Yeah, 5 million.
Right.
And now we're at 15 million per person.
Mhm.
So you're talking about married joint, that's $30 million. So
Yep.
that's a significant,
And someplace back 20 years ago, it was 650,000.
yeah.
Yeah.
So
Yeah.
look
Not
at
that
how
long
far
ago.
we've come. It's
Yep.
not that long
Yeah.
ago. So it is going to be indexed for inflation going forward. We have to really be happy about that and be happy New Jersey doesn't have an estate tax on the
Mhm.
actual estate. However, or it has the same exemption. New Jersey is one of the only places where they have something called an inheritance tax. An inheritance tax is different than the estate tax because it's actually a tax on who you give your money to.
Yeah.
And the beneficiaries are the ones that pay that tax. And
Yeah.
it's often very shocking
Mhm.
when you inherit money. If you inherit it, from your parents or,
Mhm.
if it goes in a straight line, you're a Class A beneficiary, there's no inheritance tax on that. But as soon as you're giving to your siblings or even further out,
Yeah.
or just to friends, there is this tax on it.
Mhm.
So Class C beneficiaries are your siblings, cousins out from
Yeah.
there, or nieces and nephews, I should say. And you get a $25,000 exemption, and then it's anywhere from 11 to 16% tax. It's a big
Yeah, it's a
tax
big number.
on that distribution that you receive.
Yep.
If you are just a friend or even outside of the sibling category, you're a Class B, I believe it's called, or Class D, you don't even get the exemption. So it's just on every dollar.
Yeah.
And just people are not familiar with that tax. So oftentimes I'm breaking kind of bad
News.
and there's nothing really that it's exempt from.
Right.
So it's, people think, oh, it passes outside the estate, we don't pay. Inheritance taxes on everything.
Yeah. Yeah, and which, this just happened to a client of mine and, unfortunately, her brother passed away and, she was super, super surprised to find out that, it's her brother.
Right.
Right. It's not a stranger.
Whatever reason, a brother or sibling is a Class C.
Yeah.
And you're looking at a 25,000 exemption and then starting at 11% and it goes up from there.
Yeah.
So a big deal.
Yeah, the planning for your estate should not only be the federal, it should look at the state.
Take a look at the state.
There's some ways to not have this.
Yeah, lifetime gifting, right? So if you are planning on giving to your siblings, or if you're a parent planning on giving to your children or whatever, there's ways to gift 19,000 a year, right? To as many people as you want with no tax.
Yeah.
So there's just planning opportunities.
Yeah.
You don't get surprised.
Yep. And that's what I always say to, clients is that, most clients don't mind knowing, like it's a bad circumstance, but at least I know.
I know.
It's a surprise that people get.
Yeah.
It's always and that's how IRMA is.
Right.
It's like,
You're like, what?
if you can wrap your head around it, that I'm going to have to pay this, that's one thing. But, when you get that premium in the premium bill in the mail and you're like, what the heck is going on?
Right, exactly.
That's the part of it. And then knowing that, maybe I could have planned to figure something different out.
Yeah.
Plan to have it one year and then not have it
Right.
and change when you actually paid and
Right.
So there's definitely ways around there. Here's that annual exclusion
19,000
that you're talking about doing, lifetime gifting and all those great things. So there's still lots of good things that we can do from an estate planning aspect. The one thing that I want to say, and it was on a slide about who needs a will and all that, everybody needs a will.
Yeah, everybody.
People think that, you do your estate planning, when you're in your 50s, 60s, 70s, 80s, whatever. And that's just really not true, right? Because if I knew when I was going to die, my life would be easy. I could put in all my income, my expenses, and everything. But, unfortunately, we just don't know that. And that unknown creates, potentially a lot of problems.
Yeah.
So I think that's something that everybody needs to keep in mind. And this is the biggest one, look, these are permanent until they're not. So, the rules can change as we go. The government is shut down right now over rules, right? And who gets entitled to what. So it's, kind of interesting.
Yeah, so nobody should really be lulled into like feeling like, oh, well, it's a $15 million exemption.
Mhm.
We're under that, we're good.
Yeah.
There's still opportunities to do better.
Yeah.
And so I think it's an opportunity. This is like a reminder
Mhm.
that, there's opportunities out there and planning makes a big difference.
Yep. So not to get into politics, we stay away from politics
Right.
here. We have a no politic rule. So this is not about politics, but this is just about reality. The reality is that, these tax cuts cost money.
Yeah, they're not free.
They're not free, right? And so, the federal government has ways of, collecting revenue. One of them that is newer, it's actually very old. It was the oldest way that
Right.
generated revenue in this country through tariffs
Yes.
before we had, personal income tax. And so part of those tariffs, which was the way the country raised money prior to income tax, have come back in to, not only help reduce the deficit, but help pay for these tax cuts. There's a very important Supreme Court decision coming out.
Yep.
Maybe you want to just share some insights, what you guys think about.
Do you know?
Yeah, I think so. The Supreme Court, not to put you guys on the spot, but that Supreme Court decision can have a big impact on, it's permanent till it's not. Because if the Supreme Court rules in favor of the lower courts,
Of allowing the tariffs, is that the disallowing?
Yeah. This is gonna have to be paid for somewhat.
Some other way, right?
So we put this in there just for people to sort of pay attention to what's going on. I
Right.
think all of us, especially with politics today, we just want to dive our head in the sand because, I don't know what is true anymore. Like
Right.
you hear this, is that true? You hear that, is that true? And, the one thing true that I can tell you is the Supreme Court is going to be ruling on this
Yeah,
in November.
and it will be significant
Yep.
because, how will we pay for this
How will
if
we
they're
pay for
not,
this,
if they're disallowed? Yeah.
Yep. And,
sure.
if the tariffs do end up becoming disallowed because they were, they're using tariffs under the International Emergency Economic Act,
Right.
which, is for foreign adversaries. And so the Trump administration has laid out their case for why they could use tariffs under this act. And again, a lower court said, no, you can't
Right.
go into the Supreme Court. I'm also worried about what goes on with the stock market.
Yeah.
Because if that's repealed and they uphold the lower court's decision, I think it's $36 billion a month that is coming into the coffers as of the last I read.
Okay.
So, we're going to have a situation where we can really run into a turbulent market here coming into the end of the year. So
Yeah, for sure.
again, another planning opportunity,
Right.
Not to raise panic,
Right.
to raise, caution and,
Just to make sure that your situation, if there is turbulence in the market, that you're diversified and that, nothing I know when I spoke to you, you did this really cool chart for me that showed, how the investments are and
Yeah.
it should, it was amazing.
Yeah.
So, I would advise anyone to have that done because
Yeah.
it gives you a really good picture of, do I have too many eggs in one basket,
Yeah.
right? Or do I really have everything spread out so I could survive, if there is a downturn?
Yeah, absolutely. So I really thank you guys. This was fun.
Thanks.
It was fun.
That's
It
fine.
was good.
We can do this again, and I know that we're up against time here. So just a couple of things, as we said in the beginning, everybody that attended today will be receiving a survey. Let us know how we did. We're open to doing more of these. If there's topics that are there that people are looking to learn more about, let us know. And if you're interested in having a year-end tax planning appointment consultation, let us know on that form as well. But yeah, so just some final thoughts here. So we talked about a lot.
Yeah.
I think reviewing is important, right?
Yeah, absolutely. So what you can do now, some of you already take advantage of this, but in July or even now or towards the end of the year, it's a really good idea to call us. We have a program that lets us project your taxes, your tax obligation for next year. So that's always a really good thing. You can make an estimated payment, maybe not hit that penalty for not paying enough in. It's a pay-as-you-go system.
Mm-hmm.
We can evaluate where you are as far as, are you going to be in the standard deduction? Are you going to be itemizing what that $40,000
Mhm.
lifted cap on salt is going to look like for you, which should make a significant difference for a lot of our clients. And there's some other corporate S Corp and sole proprietorship benefits with the QBI and with some bonus depreciation and things that we can talk about.
Yeah, changes are significant enough that we should look at this year and next year, because we
Yeah.
can play back and forth. And that hasn't been true for quite a while.
Yeah,
It
exactly.
didn't matter when you paid New Jersey or whatever, but
Mhm.
now you
Now it
can
does.
play around with some of this.
Yeah, I mean, just like when the salt was going away, there were people, saying, pay next year's taxes this year, and get it
Oh,
in
yeah.
this year, right?
Yep.
Right.
So I'm reading some commentary that
Forgot about that.
Yeah,
It's been a while.
yeah, so that might actually help
Yeah.
people get over the threshold.
Yeah.
Yeah, so
Yeah, your fourth quarter New Jersey estimated tax.
Yeah.
pay it now,
And-
right?
yeah.
And-
Those are the kind
and-
of things
Exactly, and so
that
you'll get it
fits
into
it.
this year and it becomes part of that salt.
Yeah.
So it can get you over that standard deduction, even if you don't maybe have a mortgage.
Yep.
Right, so just ideas where you can prepay certain taxes, and I know who wants to prepay taxes, but sometimes it can actually really be a benefit.
Yeah. Yep. I remember those days.
Yeah.
I had a few people that contacted me and they weren't gonna be able to make it today.
Uh-huh.
They wanted to know if they could see this.
They could
So
do
it
it
could
later.
Be up on a.
Yeah, we do have it recorded. So for anybody that is looking for that recording, it's going to be, I think we'll be able to put it on both Leeds and Vision.
Okay.
But you can always send us an email or reach out to the office, but visionretirement.com, leadsaccounting.com, and you can look for that recording out there. So again, guys, thank you so much.
Thank you.
Pleasure.
It's been really fun.
It has been fun.
Yeah, enjoy Halloween
Oh, thanks.
and stay warm.
Any
Thanks.
excuse to eat candy, right?
Yep. Thanks, everybody.
Well,